Hello everyone, let's give you an overview of sales and accounts receivable. Sales is a revenue account. Anytime that we as a company provide services to customers or deliver products, we earn revenue. Sales is the term that most merchandising firms use for revenue. Regardless, when you hear the term sales, you think revenue. The revenue recognition principle says that providing service or delivering goods is revenue as long as payment collection is probable. When you sell goods or services, you either get paid cash at the time of the transaction or you bill the customer, so the sale is said to be on account and you record an accounts receivable. Accounts receivable is a current asset that tracks the money that a customer owes to our business for products or services that have been sold on account. Now, you've heard about discounts being offered by companies. Discounts can be broken down into two types. They're either a trade discount or a sales discount. A trade discount takes place at the time the transaction occurs. What you're doing with the trade discount is you're reducing the price or giving the customer some type of deal in order to either get their business or increase the amount of the business they do with us. A sales discount, on the other hand, is designed to speed the payment for the customer. You want to get your cash as soon as you can, so you offer your customer an opportunity for a discount if they make payment within a certain time period. As you may or may have not experienced, anything that is sold typically can be returned or an allowance can be given. If customers are dissatisfied with the products, they either return those products or have an arrangement with the business that allows them to pay less for what they received. Those are called sales returns and sales allowances. And in accounting, these things have to be tracked so that the company is aware of what's taking place. Sales returns, sales allowances, and sales discounts are all referred to as contra revenue accounts. They reduce the amount of revenue that is earned by the business. So when it comes to an income statement presentation, you'll typically see on the first line an item called sales net. Sales net represents the difference between the total amount of sales less any sales discounts, any sales returns, and any sales allowances that have taken place during the period. Sales net is the actual earnings from the sales that have taken place during the period. When we account for accounts receivable, the key terms are accounts receivable, allowance for uncollectible accounts, or AUA, and bad debt expense. We already talked about accounts receivable. Allowance for uncollectible accounts is the account that used to report the estimate of future bad debts. In other words, this is an account that's used to track the accounts receivable that you feel you'll never collect. It's referred to as a contra asset account because it's a reduction in accounts receivable. The amount that you actually record as an expense for each period is referred to as bad debt expense. The bad debt expense represents the amount of estimated future bad debts arising from the current period's credit sales. The bad debt expense is an operating expense that'll show up on the income statement. We recognize bad debt expense this way because of the matching principle. The matching principle is an accounting concept that requires expenses to be recorded in the same accounting period as the related revenues they help to generate. The principle ensures that financial statements accurately reflect the expenses incurred to generate revenue during a specific period of time. Accrual accounting requires that we estimate the amount that will be uncollectible and the related bad debt expense using an allowance method. The allowance method typically has 3 different calculations to determine uncollectible account amounts. One would be to use the percentage of accounts receivable. Another would be to use an account receivable aging report. And then finally, the percentage of credit sales. During this course, our focus will be on using the percentage of accounts receivable to determine uncollectible account estimates. Once the estimates are used to determine the balance in the allowance for uncollectible account, an adjusting entry is recorded and posted to the general ledger. Like all other adjusting entries, accounts from the income statement and balance sheet will be used. The debit will be the bad debt expense, and the credit will be to the AUA account. The bad debt expense will be presented on the income statement as an operating expense, while the AUA will be deducted from accounts receivable to get accounts receivable net, also known as the net realizable value of accounts receivable on the balance sheet. The adjusting entries will take place at the end of every accounting period, usually that is monthly. The key risk of accounts receivable is recognizing that our customers will not make payments. While multiple attempts will be made to collect payment, the reality is that some customers will be written off as uncollectible. The write-off requires a debit to the AUA account and a credit to accounts receivable. Bad debt expense is not part of the entry because the expense has already been recorded at the time of the adjusting entry. That's it. The cycle repeats itself for every sale that takes place on account. Sales on account create an accounts receivable. The accounts receivable represents a short-term debt owed to our company by our customers. Because of the likelihood that payment will take place, an allowance for uncollectible accounts is recorded. As customers pay, the accounts receivable balance decreases and cash is collected. The cycle repeats itself throughout the company's fiscal year. I hope this gives you a pretty good idea of what sales and accounts receivable is all about. Thank you for watching the video. Good luck.